Want to see all the fun we were having on the convention floor? This is the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statement expressed herein are our own and not necessarily those of NJCPA, CLA, Witham, or Prager Metis. So, to the convention floor, take it away, Brad. Wow, Frank, what a great convention this is. I mean, an enormous turnout. Last night was phenomenal.
I had a great time.
I mean,
loving this.
Look at this.
I got there? What do you got there?
From PPAC.
Wow.
I got Ion Bank. We've got Gordon standing over there.
Wow.
Okay. Got from Jerry McGinnis's book, accounting stuff.
That
it's
looks
unbelievable.
good.
And of course, our premier sponsor, ADP.
And I got Affinity Credit Union here. Look
Wow.
at this. You can't beat this stuff.
No, this
and
is
all
great.
the people and networking. This is phenomenal.
Incredible, incredible. So we're here though to talk about an important topic. We're going to start talking about SAS 143.
Okay.
Auditing, accounting, estimates, and related disclosures.
Come on, guys. I estimate you guys are going to screw this up.
Hold on a second. Here. I
You're gonna have
want
my
the
dessert.
Affinity. I want to have this.
You want the dessert? as
No, I
usual?
don't want the dessert, but I'll take the candy bar.
Okay, you take the candy bar.
And I'm going to
enjoy
eat it too.
What do you know about SAS 143?
Well, we're talking about estimates, and
Yeah.
that there's a new, it comes out and says that we need to do things differently than we have in the past about two factors, about management bias and estimation uncertainty.
Mm-hmm.
And estimates by their nature are uncertain. You get a whole bunch of people and ask them the same question, and you get different answers, and they all can be valid and correct and based on reasonable assumptions. So how do you go about auditing that and figuring that out when...
I mean, so you said estimates by themselves are uncertain. So we've been auditing these in the past. We haven't been doing good enough? No. Right? No, you can be honest.
Evidently not, but now things have gotten a lot more complex with newer issues that have come up, and it's made it more difficult, and so now we're required to do a deeper dive into those areas and apply some other audit procedures we may not have done in the past.
Okay.
So it's a little challenging.
Well, because some estimates are more complex than others. So if you have a complex estimate, you have to look at the risk. That management's going to be biased and not actually come up with the right calculations. So now you have to do inherent risk. You have to assess inherent risk at the assertion level, control risk at the assertion level.
So the first thing you have to do is get an understanding of what uncertainties, what estimates are there.
Yes.
The level of uncertainty about them. And so first, the one thing I liked about this pronouncement when it came out, they truly made this scalable. And what that means is you're supposed to look at the estimates and say, how significant is it?
Right.
Okay. How susceptible is it to uncertainty? Right.
Yes.
To your comment. After I've determined that, then we go to...
You have to do risk assessment of it, because everything's about risk assessment now. So we have to look at the risks that the estimate could be incorrect, and we have to now, how do we audit that? So now you come up with your assessment on the risk, and now you have to determine what procedure should I perform to ensure that that management has determined the correct estimate. And you might have estimates that, like depreciation, simple estimate, non-complex, you probably don't have to do all the risk assessment for that. But now you have goodwill, and you're now valuing goodwill. That's a very complex, a lot of different calculations. You have to spend more time and understanding what management's estimation is and how they determined it. So you got to follow that through.
So previously, 143 came out, 145, and we can go through all the others. 145 was a significant change with risk assessment. Mm-hmm. And in the past, the forms, we won't go through the names of the providers, but we know one of the big ones, just had a checklist of all areas.
Okay.
And right, and you would see it, people would just go down and check off every box.
Right.
Every box would be checked off.
Right.
And it's like, wait, these are all estimates, and they might be estimates. Mm-hmm. But how significant how significant is in general? Now, I think it was SOP 94.6, because I'm a loser. Okay, SOP 94.6 came out and said significant estimates. You have to disclose significant estimates themselves.
Yes.
And a significant estimate is it will change in the near term, and that change could be material.
Right.
Right.
Okay? So it was there a while ago, but people would just take that checklist and go boom, 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 and not address it any further.
Correct.
So now they've got to go down, identify them, determine their significance, really, truly. And if it is significant, if you're going to say it's significant,
Right.
then you've got to go in
And they got to
further.
do the whole audit procedures and again, have to determine what the risk is that there might be material misstatement. And that's a whole,
So you're bringing another thing into play is materiality
Yes.
of the items. And classically, we've always had the allowance for doubtful accounts as your classic estimate. And with the new credit loss standards, it's a little enhanced. But reasonable people can come up with different estimates and justify them. And what's right and wrong is very subjective, and there probably isn't a right answer tangibly, but how do we know that it's not materially misstated by what they're doing and how they are estimating it and the logic they go with within the risk of everything else? And an area of that one is self-funded healthcare, incurred but not recorded claims, IBNR,
right?
where you're using all kinds of actuarial assumptions, very complicated, very complex. It's difficult to audit that because a small change in assumptions can have a significant and very material impact on the financial statements. It's a challenge.
So that one's very interesting, the IBNR. Let's talk about that for a little bit, because at least you're getting outside information.
Right.
When you're talking about maybe goodwill, where they're just doing their own internal calculations, that leans in a lot towards management bias.
Right.
And that's very difficult to view or to get your head around on the management bias and make sure that you're focusing on that, because IBNR, there's a lot of risk there. Don't get me wrong, just because I said there's outside people doesn't mean there's no risk. That's very significant.
Right.
But then when you go to an impairment of goodwill,
Yes.
well, now they have to start doing cash flow analysis. It's usually prepared by management.
Typically.
You can get a third-party appraisal, but for the most part, it's prepared by management. How much management bias is there in that now? Sales are going to go up. Really? Your sales have been going down every month.
There's no management bias. They are completely playing it straight down the middle. Did I get that out with a straight face?
Right, you did.
But I think some companies play it straighter than others, and you've got to evaluate that in part of what you're doing, because every CEO goes, this goodwill, especially if I bought it, is still worth much more than I paid for it because of other aspects that may not have to do with any financial reporting, but because they've got to report to other people and don't want to admit they made a mistake. But you've got to go through the cash flow, and you've got to get information. And again, if somebody else did it with similar fact patterns with different assumptions, you get a different answer. And is that material, and how you audit that is a significant challenge.
And how you audit that is very significant, because as you mentioned, cash flow, they're putting in numbers in there and they're coming up with their assumptions. How do we audit the cash flow? What procedures do we have to perform to ensure that the cash flow is reasonable? Same thing with revenue. How do they support that? How do we audit that? So it's a very complex area we're getting into, and it's just becoming more and more work for the auditor.
And I think one of the factors even said in there is auditors, further audit procedures need to be responsive to the reasons of the assessed risk.
Yeah, absolutely.
So we've got to start focusing on it more. And just because they gave you the cash flow, you've seen it before.
Oh, yeah.
How did most auditors audit the forecast? What did they do? I saw they footed it.
They footed
They
it.
footed it.
They footed it.
It's called you have to audit the inputs.
Right.
And especially if management is giving you this information, we're not picking on management.
Right.
Management bias, personal bias is there anywhere. There's auditor's bias, I'm sure.
The point you just mentioned, management bias, but the key there is, it's not so much management integrity, but you have to understand what's management's position. What are they trying to accomplish?
Right.
And you have to be skeptical. We can't just say, well, management, they've been a client for a long time. We have to be skeptical that maybe they are making a mistake. Maybe there's a reason. There's bonuses tied into the profitability of the company. And that would lead into not impairing goodwill. So a lot of factors go in here. This is a very, very complicated area.
It goes back to one of the things we first learned when we started in the profession, professional skepticism.
Yep.
You need to be skeptical in everything you're doing, and this is taking and saying, hey, with everything they're giving you, you need to have that professional skepticism and say, they're giving you this forecast which shows everything's rosy. How reasonable is it? how reasonable are the assumptions, and you can have to do a retrospective review from taking a look in the past and going, how accurate have their assumptions been in the past?
That's a big one.
Yeah.
So we keep talking management, and I'm sure the people out there saying, oh, they're beating up on the controllers and the CFOs. We're not. Allowance for doubtful accounts. The controller is going to go to the credit manager. Credit manager is rated based on their collections. They're going to say, oh, it's collectible. Really? Well, last year you told me it was collectible, but it's still on the AR. I know, but this time it's really collectible. Okay. So the retrospective analysis is really significant, and I think it's something that we as auditors are not doing enough of. What were the estimates last year? What were the results of the estimate?
Absolutely.
So I think we need to look at that a little bit more.
Right, and I think the allowance is an area where it's easy to do, and we probably have done that in the past by looking at the history, but on some of these other things, we haven't gone as deep and looked at it, looked at what the real cash flows were on goodwill, looked at the IBNR, what the actual claims have been as you're building up history. And we need to do more of that. And the problem with that is it's time consuming, it's not that clean cut, and it just adds more complexity and risk to the audit period, which we don't like.
And it's not just the numbers, it's the disclosures and the positions.
Yes.
Because you went to 842 was effective last year. We had to put the leases on, but I'm not going to renew. I'm not going to renew. Really? Right. So it's an estimate now of this asset and liability based on you saying you're not going to renew. How accurate, or what's their bias? Well, they want to keep the liability off the books.
Sure.
So,
and the disclosures have to be more transparent. Right? You're now required to have more transparency in disclosures. All the items, you now, because it's in a note to the financials, we have to now audit those notes.
Sure.
We have to audit those assumptions, how reasonable those assumptions. So, like I said, it's a very complicated area, a lot more involved than people might actually think.
Yep. So
absolutely.
Yep. So Jay, thanks for intruding again. I don't know. Every year we keep doing this, and you hear us, and you want to beat up on us. I don't know.
And he keeps eating my dessert.
So
it's good dessert.
Don't miss this convention next year. Come by, see us taping, look at all the wonderful stuff that's going on, the great vendors. I want to thank you for watching or listening, and I want to give it back to you, Brad. Wow, that looked like a lot of fun. Thanks, Brad, Jay, and Frank. In closing, here's some upcoming accounting and auditing events. On July 17th, the Society is holding its annual Government Accounting and Auditing Conference. Get info for this event and more at the njcpa.org/events. And of course, be sure to join the Society's Accounting Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.